The market's engines seem to be slowly restarting after the summer holidays, and we must note that volatility came early for investors. Please note that currently the US employment report for August is still to be released. Hence, we may see the markets in turmoil as the week draws to an end. On the monetary front, we highlight the release of RBA's, BOC's and ECB's interest rate decisions on Tuesday, Wednesday and Thursday respectively. Also, a number of policymakers from central banks around the world are scheduled to make statements and could sway the market's opinion. As for financial releases, we make a start on Monday with Turkey's CPI rates for August and Switzerland's GDP rates for Q2, while on Tuesday we get Australia's current account balance for Q2, Germany's industrial orders for July, and from the US we get the ISM non-manufacturing PMI figure for August. On Wednesday, we get Australia's GDP rate for Q2, China's trade data for August, Germany's preliminary GDP rate for Q3 and industrial output for July, UK's Halifax house prices for August, Eurozone's GDP rate for Q2, and in the American session, Canada's trade data for July. On Thursday, we note the release from Japan of July's current account balance and revised GDP rate for Q2, while from Australia, we get the trade data for July, and from the US, the weekly initial jobless claims figure. On Friday, we get China's inflation metrics for August and Canada's employment data for the same month. The USD index is about to end the week higher than when it began, yet we note that the US employment report is still to be released and could alter the greenback's direction. Overall, the main element moving the markets in the past few days has been the Fed's intentions. It should be noted that Fed Chairman Powell last Friday at the Jackson Hole Summit signaled that interest rates are to rise further and underscored the bank's determination to curb inflationary pressures in the US economy. Also, the Fed chairman warned that rate increases will bring some pain to households and businesses, adding that such hardship is the cost of reducing inflation. The speech practically erased any hopes of the market for a dovish pivot on behalf of the Fed, which in turn hit US stock markets, causing them to drop as the monetary policy is to continue to tighten, with Fed policymakers being fully conscious of the actions and possible repercussions. Hence, draining the market of its liquidity could cause US households to reduce or at least restrain their expenditure. Also note that the US employment market seems to remain rather tight until July at least, which allows the Fed to maintain its hawkish stance. It's worth pointing out that following statements from other Fed policymakers tended to complement Powell's hawkish comments. It's characteristic that Cleveland Fed President Mester on Wednesday was reported stating that benchmark rates may rise above 4% in the coming months, while also stated that she does not expect any rate cuts in the coming year. Also, Ms. Mester stated that she sees growth running well below 2%, which exactly highlights the possibility of a prolonged period of scarce business opportunities. As for financial releases, we note the release of the US ISM non-manufacturing PMI figure for August on Tuesday and the weekly initial jobless claims figure on Thursday. Please note that Monday is a public holiday for the US and stock markets are to be closed, while given the low number of high-impact financial releases from the US, we expect fundamentals to drive the greenback. The pound seems about to end the third week in a row in the reds against the US dollar and has also weakened significantly against the euro, yet tends to remain rather stable against the JPY. On the macroeconomical level, we note that UK's economy did not have the best news this week, as the manufacturing sector showed another contraction of economic activity for August, the first post-pandemic. On a more fundamental level, we highlight the race in the Tories party for the next leader of the Conservatives and de facto next Prime Minister. The race is between former Chancellor of the Exchequer Rishi Sunak and Foreign Secretary Liz Truss. Various promises have been made by both candidates, yet Truss seems to be conservatively more radical than Sunak, who seems to be more moderated. For the time being, Truss is reported to show a wide leading margin in the polls. The ballot is to close today, the 2nd of September, and the next leader to be announced on Monday the 5th. Overall, a period of uncertainty in UK's political scene seems about to close, and that could prove to be beneficial for the markets. On the other hand, though, we tend to maintain some worries for Truss's intentions. It's characteristic that Liz Truss wants to review the mandate of the Bank of England, and media report a possible curtailing of the bank's independent decision-making on interest rates, an issue that is vital at the current stage for the UK economy. Also on the monetary front, we note that on Wednesday, the 7th of September, BOE Governor Andrew Bailey, BOE Chief Economist Pill and MPC members Mann and Teneriero are to appear before the UK Parliament's Treasury Committee for questioning regarding the bank's latest interest rate decision. The bank at the time had decided to hike rates to the level of 1.75% and forecasted that inflation would reach 13% year on year. We expect overall a hawkish tone to prevail from the BOE policymakers in an effort to defend the decision, citing once again high inflationary pressures. As for financial releases from the UK, we note the release of the final services PMI figure for August on Monday and the Halifax house prices for August on Wednesday. JPY is about to end the week weaker against the US dollar for the third consecutive week, but it's also weaker against the euro and remains relatively stable against the pound. It should be noted that JPY dropped to a 24-year low against the US dollar, creating worries for the markets and mostly Japanese officials. It's characteristic that policymakers are reported by Reuters stating that they were watching currency moves with a high sense of urgency, using strong language to hint at the possibility of eventual market intervention. Also Reuters reported that Chief Cabinet Secretary Matsuno stated that currency market volatility is heightening recently and that sudden exchange rate fluctuations are not desirable. As mentioned in prior reports of ours, the weakening of JPY was considered to support the economy, as it would make Japanese products cheaper, thus more competitive in the international markets. Yet now it's a troubling issue for Japan, as it drives the costs of imports also higher, thus accelerating inflation as well. It should be noted that on a monetary policy level, BOJ, in contrast to other central banks that have tightened their monetary policies, BOJ kept monetary policy settings largely unchanged, preserving an ultra-loose approach and seems to be intending to keep it that way. It's characteristic that BOJ policymaker Nakagawa stated on Wednesday that there are risks to the country's fragile economy, therefore highlighting the need for a continuation of the monetary settings for the time being. The dovish stance of the bank could weaken the JPY further, given that the monetary policy outlook of BOJ compared to other central banks tends to have an adverse effect. On a more fundamental level, though, we would note that the dual nature of JPY as a national currency and a safe haven could continue to be on display once again next week, creating inflows for the Japanese currency in times of turbulence and vice versa. As for financial releases, we would like to note the release of the final services PMI figure for August on Monday, while on Tuesday we get the all-household spending growth rate for July. Lastly, on Thursday, we would highlight the release of Japan's revised GDP rate for Q2 and current account balance for July. The euro is about to end the week slightly high against the US dollar and is gaining considerably against the JPY and GBP in a sign of a broader strength. On a fundamental level, the situation in the Eurozone seems to remain worrisome, to say at least. On the one hand, the ongoing political instability in Italy, in conjunction with market worries for a possible default of Italy, and on the other hand, the cut of Russian natural gas supplies tends to create a grim outlook for the zone. On a more macroeconomic level, we note that the economic sentiment for the zone has dropped in August, implying a greater degree of pessimism, and that the consumer morale also seems to remain low for the same month. Also, the contraction of Germany's economic activity in the manufacturing sector does not bode well for the euro. On the other hand, we have to highlight the acceleration of inflationary pressures in Germany beyond market expectations, but for the Eurozone as a whole as well for the month of August, the latter being evident by an HICP rate reaching 9.1% year on year. The acceleration of inflationary pressures is expected to add further pressure on the ECB to proceed with a wider interest rate hike in its next meeting on Thursday, possibly of 75 basis points. It's characteristic that the market seems to be almost fully pricing in such a scenario for the deposit rate currently, according to Euro OIS. It was also characteristic that ECB's board member Isabel Schnabel stated that forceful action is needed to curb inflationary pressures, even if that would drive economies to a recession. The comments were made at the Jackson Hole summit last week, and since then inflation accelerated further for August. We see the case for a 75 basis points rate hike currently and would not be surprised to see the bank adopting a confident hawkish tone in its accompanying statement, which could provide some support for the euro. On the other hand, should ECB President Lagarde seem to hesitate about the size of future rate hikes, given her statements that future decisions are to be examined at a case-by-case basis, we may see euro traders being disappointed. As for financial releases, for the euro we would make a start on Monday with the release of the final services and composite PMI figures for August, as well as the Sendex index for September. On Tuesday we get Germany's industrial orders growth rate for July, and on Wednesday we note the release of Germany's preliminary GDP rate for Q3, industrial output growth rate for July, and Eurozone's revised GDP rate for Q2. AUD is about to end the week low against the US dollar. It should be noted that Aussie traders may have been disappointed this week, as Chinese factors seem to continue to struggle, given that the NBS manufacturing PMI rose slightly yet remained below the reading of 50, and the Caixin manufacturing PMI also dropped below the reading of 50, both for the month of August, both implying a contraction of economic activity for the Chinese giant. Further contraction of economic activity for China's manufacturing sector could imply less exports of raw material from Australia, yet there were also worrying signals from the Australian economy as well. The capital expenditure growth rate for Q2 failed to get out of the negatives, implying that Australian businesses may lack the confidence to actually invest in the Australian economy. Also, the building approvals growth rate showed a contraction of a whopping 17.2% on a month-on-month basis, a no bueno for the Australian construction sector. On a more positive side, we highlight that the retail sales growth rate for July accelerated more than expected, which is good news for RBA, as the bank had placed particular weight on the spending habits of Australians in its last interest rate decision. On Tuesday, RBA is to convene again, and the bank is expected to hike rates by 50 basis points, raising the cash rate to 2.35%. Yet currently there seems to be a slim possibility for such a scenario, as OEUD ORS imply a probability of 58.86% for such a scenario to materialize, while the rest tend to imply a mere 25 basis points rate hike. Hence, given that there is a certain degree of uncertainty to the actual size of the rate hike, should the bank proceed with a 25 basis points rate hike, we may see Aussie traders being disappointed. On the other hand, should the bank actually proceed with a 50 basis points rate hike, yet signal in Governor Lowe's accompanying statement some degree of uncertainty, we may see the market once again being disappointed. Please note that on the monetary front, RBA Governor Lowe is scheduled to have a speech on Thursday as well that could be of interest. As for financial releases, Aussie traders are to have a packed schedule, as on Monday we get Australia's final services PMI figure for August, and on Tuesday we get Australia's current account balance for Q2. On Wednesday we highlight the release of Australia's GDP rate for Q2, while at the same day we also get China's trade data for August, with the import growth rate being of particular interest for AUD traders. On Thursday we note the release of Australia's trade data for July, and on Friday we get China's inflation metrics for August. The CAD is about to end the week low against the US dollar for a third consecutive week. On a macroeconomic level, Canada's metrics may have failed to satisfy the market's expectations, thus weighing on the loonie. It's characteristic that the GDP rate for Q2 on an annualized basis failed to reach the forecast, while the current account surplus failed to rise for Q2 if compared to the respective reading for Q1. Even worse, the building permits growth rate contracted by minus 6.6% month-on-month for July, and the manufacturing PMI figure showed a contraction of economic activity for the sector, as its reading dropped below the reading of 50 for the month of August. The latter two may have also been a result of the tightening of BOC's monetary policy. Hence, we highlight the release of BOC's interest rate decision on Wednesday. The bank is expected to hike rates by 75 basis points, with CAD ORS implying a probability of 56.82% for such a scenario to materialize currently, while the rest seem to favor a scenario of a 50 basis points rate hike being decided. Should the bank actually proceed with a 75 points rate hike and show decisiveness in curbing inflationary pressures in the future meetings, we may see the loonie getting some support. On the other hand, given the positive correlation of oil's price with the CAD, we cannot miss out on commenting at the recent drop of oil prices. WTI's price is about to end the week lower as the tightening of monetary policies around the world intensified market worries for a slowdown of economic activity and thus also a reduction in the demand side of the commodity. Should such worries continue to torment the oil market, having a detrimental effect on oil's price, we may see also the CAD being adversely affected. Last but not least, we would like to highlight the release of Canada's employment data for August on Friday. In the last release, data were not so encouraging for CAD traders as the employment change figure was at minus 30.6k, albeit the unemployment rate remained at the low level of 4.9%, implying some tightness on the Canadian employment market. Should there be an upward correction of the employment change figure and overall should the data show a rather tight employment market, we may see the CAD getting some support. On second base, we would also like to note the release of Canada's trade balance on Wednesday, albeit it may be overshadowed by BOC's interest rate decision the same day. As a closing comment, we expect the greenback to relent some of its advantage over other currencies in the determination of FX markets' direction, given that the number of high-impact financial releases stemming from the US are fewer than the week before. Especially the interest rate decisions by the ECB, BOC and RBA, but also a number of high-impact financial releases may turn the spotlights towards their respective currencies. We expect also that should the cautious sentiment continue to dominate the markets, we may see riskier assets such as equities and commodity currencies weakening. Especially for US stock markets, we highlight the worries stemming from the further tightening of the Fed's monetary policy, as that would imply less opportunities for business development and profitability. Thus, the Fed's rate hikes may lead the US market, if not in a recession, in a prolonged period of low growth, with the possible adverse effects being reflected also on the earnings reports of Q3 and Q4. At this point, we would also like to express our worries for the US yield inversion, as the 2-year yield is higher than the 10-year yield, signaling currently that the risk for a possible recession in the US economy might be sooner rather than later. Last but not least, we must note that gold's price dropped for a third consecutive week, as the strengthening of the greenback tended to weigh on the precious metal. We expect the negative correlation with the USD to be maintained in the coming week and could define gold's direction.
Carry trade refers to the trading strategy with which traders sell a currency at a low interest rate and invest in another asset that has a higher rate of return. In forex trading, interest is debited or credited daily from a trader's trading account based on open positions. Now, let's say that the US interest rate for a deposit is 2%, while in Europe is 0%. If the rate for the Euro-USD pair remains stable in the following year, those traders that are aware of this would borrow funds from Europe but make a deposit in the US. This way, they would benefit from the difference in the interest rate, that is the 2% risk-free return. This type of trading method, where money is carried to another location, is called carry trade. In fact, did you know that selling JPY while buying AUD, GBP or NSD has been the most popular carry trade for the past few years? Taking another example, if traders want to borrow 1 million euros to carry the US with an interest rate of 1.10 for Euro-USD, they would actually be depositing $1.1 million in the hope of receiving back $1.122 million next year. Assuming that the interest rate remains the same, the trader would get back 1.2 million euros, hence a 20,000 euro profit. However, since exchange rates usually change, if the exchange rate changed to 1.11, the trader's profit would then be reduced to 10,800 euros. In any case, carry traders are not an easy endeavor, but rather a high-risk strategy that requires traders to have years of market expertise and solid risk management techniques in place. Stay tuned for more.
So welcome everyone once again to our webinar today. We will be doing advanced moving average strategies. We're going to go through advanced moving average. You guys already know moving average. This is the most simple form of technical analysis. I personally, when I just started trading, this is the first indicator I've ever learned, and you guys will be surprised. I paid quite a bit to learn this because I signed up for one of those crazy trading courses. Nowadays, things are free, like you guys join this webinar for free, right? Yes, so back then I had to pay like thousands to learn the moving average. I know how ridiculous that sounds. Okay, let's do the disclaimer first. So just a warning, a reminder that whatever I share in this webinar should not be construed as trading advice. It should only be taken as educational. Okay, this is only an educational webinar. The whole point of this webinars by IronFX is to help you guys grow as traders. Okay, it is to help you guys grow as traders, right? Please don't take it. There's no signals, there's no forecasting here. Okay, if you guys are waiting for the entry, the take profit, the stop loss, you're not going to find it in this webinar, because we can advise you when we think it's a good entry, but ultimately it's your choice. Another reminder, trading forex and CFDs carry significant risk and may not be suitable for all investors, right? So do be cautious, especially if you are new here. The risk multiplies immediately, especially if you are going on leverage or margin, right? So please do be cautious. For those who are new here, do not jump into the ocean without first learning to swim. Okay, for those who don't already know me, I think I've taken you guys once or twice before, right? For those who don't already know me, my name is Cass. I am an investment analyst and a prop trader here at Everest Fortune Group. So Everest Fortune Group, we're an award-winning research firm based in Singapore. We're a fintech company. Okay, what we do, we heavily research on strategies, back testing, and we advise the banks, brokerages, financial institutions, hedge funds on where we think the markets are going. So we do a lot of research on the characteristics of the market, where it's going, how it reacts, and blah blah, and we try to find strategies to overcome that. And like today, we are going to share the strategy that you can use with moving average. Okay, so Everest Fortune Group, we're the finalists for the best forex and best equity research for 2019, 2020, and 2021. Back to me, sorry. I personally am managing actually it's way more than 300,000 now. Okay, I'm managing quite a bit of funds, way more than 300,000 US dollars on my own personal account. That's me as a trader. I've passed FTMO twice, and I've passed my forex funds twice. So for those who don't know what these are basically prop trading tests that requires you to have a 10% profit within the month. Okay, so I've done that consistently month after month, and hopefully as I go with you in this webinar, I can show you guys how I managed to do that 10% every month. Okay, cool, everyone, cool for now. Okay, I'm gonna move on. Okay, so our agenda for today will be to understand what moving averages are. Okay, and then we're gonna look at some of the common moving averages out there. We're gonna look at two today, and we're going to look at the natural moving average. So natural moving average is a kind of strategy, moving average that we use here as average fortune group. If you Google natural moving average, you won't be able to find a lot of information on it, because why? I think it's kind of a bit like it's something that we invented in a way, the natural moving average. Right, so this is because I was saying we spent a lot of time back testing and looking out for strategies and patterns on the chart. So we found that the natural moving average is a strategy that works very well on when it comes to trading. Okay, so just bear with me. We will get to the natural moving average towards the end of the sites or midway of the sites. And lastly, we'll be identifying reversals with the natural moving average. And if we have enough time, right? If we have enough time, we will be moving to trading view so that I can show you guys ultimately live examples of how this will work. Why? Because look, I love doing this webinars for you guys, right? It's a lot of theoretical stuff. It's a lot of textbook stuff, you know what I mean? So I can tell you what the moving average, the definition of the moving average. I can tell you the calculation of the moving average, blah, blah, blah. I can tell you so much about the moving average, but ultimately, if you don't know how to apply the moving average, it would still not be useful. You know what I mean? If I give you a pen and you don't even know how to do what to do with the pen, you don't even know how to write, that pen will just be obsolete to you, right? So ultimately, we will try to go to trading view if we have time to kind of apply the moving average and see how it works. Okay, so before I move on, can you guys just let me know in the chat box if any of you use the moving average to trade? Have you ever heard of it, at least, the moving average? No, no one? Okay, thank you, Lola. No one has ever heard of moving average. It's the most, I try but don't understand. Okay. Yes, we got a lot of yeses. Yes, this is not unusual because, again, I said it's one of the most common indicators. I only look at it at a very basic level. Yes, me, myself, personally, I only use moving average on a very basic level, and I'll show you guys why later on towards the end of the webinar. Okay, so moving average, when I just started using it, I learned it very simple. Okay, if price, let me grab my pen so I can show you. So when I went for these crazy courses where I had to pay so much money to attend, the guy basically taught me that when price crosses above the moving average, you should get in for a buy. Okay, when the price goes below the moving average, you should get in for a sell. Okay, that's what I learned about the moving average. It works sometimes, doesn't work sometimes. Most of the time, it doesn't work that well. Okay, that's why you should never use, although today's topic is moving average, I must say, because like every week we'll go through different topics, right? Sometimes we'll go through moving average, Ichimoku, trend lines, support resistance, whatever it is. You should never use one technical indicator on its own to look for entry, stop loss, and take profit. It should never be only one to look for your analysis. It should always be a combination of all things to look for your analysis. And I want to use this example, which I am sure you guys heard when I took you the last time. It's the same as like you're going to a mall, you're buying a pink dress, okay? You see the pink dress, you don't know if it's good or not. So if enough people tell you that the pink dress is nice, you are going to buy it, right? But if everyone keeps telling you it's a no, you're not going to buy it. So it's the same. It's the same as like you going to your dad, hey, does this dress look nice on you? And then your dad goes like, yes, it does look nice on you. And your mom says, yes, it looks nice. Your sister says, yes, it looks nice. And your brother says, no, it doesn't look nice. Okay. So similarly, when we're looking for trades and setups, we need different technical analysis to give us data and, well, not opinions, but more like analysis, right, of where those technical analysis think price is going. So if enough technical analysis is telling you that price is going up, you are going to get in for a buy. If enough technical analysis is telling you price is going down, you are going to get in for a sell. Okay, right? So moving average is just a tiny part of your entire analysis. Okay, it is maybe your dad. When you ask your dad, hey, is this dress nice? Moving average will tell you yes or no, it's nice or not. That means moving average will tell you it's a buy or if it's a sell. Okay, support resistance will be your mom. Okay, trend lines will be your brother. Okay, and so on and so forth. Okay, so again, moving average is just a tiny part. So let me explain what moving average is in a very textbook definition, right? Again, I will go through all the textbook stuff, all the theoretical stuff with you, but ultimately you need to be able to grasp. Hey, Fauzan, welcome to the webinar. You need to be able to grasp how to use this indicator, the best way to use this indicator. You can know this in and out, but if you don't know how to apply it, there's no use. Okay, so let's go through the textbook definitions and all a little basic backstory on the moving average, and then we will try to go into applying it. Okay, so a moving average is a technical indicator that market analysts and investors may use to determine the direction of a trend. Okay, it sums up the data points of a financial security over a specific time period and divides the total by the number of data points to arrive at an average. Okay, it is called a moving average because it's a continually recalculating based on the latest price data. Okay, to put that in the most simple terms that I can think of, right? That is the most textbook definition you can think of. Let's say you see all these candlesticks, okay? If you put your moving average settings to 5, it's basically taking the price of the last 5 candles and dividing it by 5. So it's basically the average of the 5 last candles. If you put the settings at 20, it's the average of the last 20 candles. If you put it at 100, it's basically the average of the last 100 candles. That's why you can see most of the time the moving average is there a best moving average? You know, when it comes to technical analysis, I don't think there's ever a best of anything. It's whatever works the best on whichever time frame and whichever charts you are looking at. So I'll give you an example. There are certain pairs, there are certain forex pairs on certain time frames works well on a strategy that we have found here at FS Fortune Group. It's called the Nike Tick strategy. That's a totally different webinar. Okay, we found that that strategy works very well on gold. Okay, but that same strategy does not work very well on AUD USD, for example. Okay, so there's never a best of something. There's always which works best at that particular time frame and that particular pair and that particular instrument. Okay, that's why backtesting and research. I have to say, I don't think trading is hard. I think it's a very simple thing. You can probably teach it to a 12-year-old and they will be able to get trading. Like, what's so hard? You just buy and you sell, you put a stop loss and you take profit, right? It's not hard. The hard part is the time consuming part is actually backtesting and learning how to trade. That is the time consuming and the hard part, to be able to grasp and be able to collect all this data. Okay, so that I think is the harder part when it comes to trading. Okay, I hope that answers your question. So okay, let me continue with the definition of moving average. So analysts use the moving average to examine support and resistance by evaluating the movement of an asset's price. A moving average reflects the previous price action movement of a security. Analysts and investors then use the information to determine the potential direction of the asset price. It is known as a lagging indicator. Yes, moving average is a lagging indicator because it trails the price action of the underlying assets to produce a signal and show the direction of a given trend. Okay, I'll tell you guys, when I started using the moving average, I was not making a lot of money. This was when I just started trading. Okay, why? Because the moving average is a lagging indicator. It gives you information that is slow. Okay, so in the beginning, when I was losing a lot of money in trading, I was thinking to myself, this indicator is so dumb. Why is anyone even using this indicator? You're only right like 4 times out of 10 times or 3 times out of 10 times, whatever it is. And the times that you are right, you don't even make that much. When you lose a lot, okay, whatever it is. I was blaming the indicator. So now that I've learned as I grow as a trader, it's not that the moving average is completely useless. It's just like, maybe right now I find that I really love the Ichimoku cloud indicator, right? So to me, the Ichimoku cloud indicator is a Ferrari, and the moving average may be like a maybe a mom van, for example, maybe a van. Okay, so if you were to race, obviously the Ferrari is going to win, right? But it doesn't mean the van is completely useless. The van is still going to get you from point A to point B. It's just that the van is going to get you from point A to point B. It's more fuel efficient, maybe. It gives you more room. You can fit more people in the van compared to the Ferrari. So every indicator has its pros and cons, okay? So the moving average as well has its pros and cons, even though it is a lagging indicator, and we will look into that, okay? So a moving average is a technical indicator that investors and traders use to determine the trend direction of securities. It is calculated by adding up all the data points during a specific period and dividing the sum by the number of times periods. The average moving averages help technical traders to generate trading signals. Okay, again, the general thumb of rule is if price breaks above the moving average, you are bullish. If price breaks below the moving average, you are bearish. But in this case, you can see how it didn't work out here. It wouldn't have worked out here because price was moving sideways. Okay, so that is the definition. The common moving averages out there. Today, we are going to look at 3 kinds of moving average. One is, oh, sorry, I don't know why I put the weightage moving average in there. We're not going to be looking at weightage. Okay, we're going to be looking at the simple moving average, which is the most common moving average out there, and the exponential moving average. Okay, so this is basically the calculation. When I look at it, I don't like, I know if I refer to my notes or whatever, I know what it means, but just one look, I wouldn't know, and that's totally fine. Again, more importantly is how you apply the indicator. More importantly, you don't know how your clothes are made, right? You don't know how electricity works, right? But you know how to turn on the switch, right? You know how to turn on the switch to use the electricity. So the same, this looks very complicated. More importantly, we need to know how this works, okay? So let's start with the simple moving average. The simple moving average is a straightforward technical indicator that is obtained by summing the recent data points in a given set and dividing the total by the number of the time period. So traders use the simple moving average indicator to generate signals on when to enter and exit a market. And SMA is backward looking, and it relies on the past price data for a given period. It can be computed for different types of prices. So for example, you can get it from the high, the low, the open, and the close, okay? In financial markets, analysts and investors use the SMA indicator to determine buy and sell signals for securities. The SMA helps to identify support and resistance price to obtain signals on where to enter or exit a trade. When generating the SMA, traders must first calculate this average by adding prices over a given period and dividing the total by the total number of periods. The information is then plotted on a graph. So the formula for simple moving average is written as, this was a calculation. Let me go back to the last slide. So yes, this is basically a calculation, okay? It's basically, let's say you choose 5, right? Let's say you choose your period as 5. So let's say the first price was 1, 2, 3, 4, and 5. Okay, you add 1, 2, 3, 4, and 5 together, you will get 15. Okay, and then you take 15 and you divide it by 5, you will get 5. Okay, so that's basically how you calculate the moving average. It's just the average of the period that you chose. Okay, it's as simple. It's basically the name. It's just the average. And why is it called moving average? Because it's literally a moving average. Okay. So A is the average in periods and N is the number of periods. Okay, everyone good? Gonna move on to the exponential moving average. Okay, so the exponential moving average, which gives more weight to the most recent price points to make it more responsive to recent data points. So the exponential moving average is not as lagging compared to the moving average, okay? An exponential moving average tends to be more responsive to recent price changes as compared to the simple moving average, which applies equal weight to all price changes in the given period. When calculating the exponential moving average, the following 3 steps are used. Let me show you the calculation again. This is the one, C minus P times 2 over N plus 1 plus P, okay? Okay, so yeah, 3 steps that I use are, number 1, you calculate the simple moving average for the period. The EMA needs to start somewhere. So the simple moving average is used as the previous period's EMA. It is obtained by taking the sum of the securities closing prices for the period in question and dividing the total number of periods. Okay? It's similar to the simple moving average, but you take the price from the close. Okay. Number 2, you calculate the multiplier for weighting the exponential moving average. So the formula for calculating the multiplier is as follows. Multiplier equals to 2 divided by the selected time period plus 1. So for example, if the time period is in question is 10, the multiplier will be calculated as 2 divided by 10 plus 1. Okay, so the 2 divided by x plus 1 is fixed. I'll just quickly go back. I know this is, so 2 divided by n plus 1. The n is the variable that changes, okay? And then you'll get your answer. So the last step is to calculate the current exponential moving average. The last step calculates the current EMA by taking the period from the initial EMA until the most recent time period using the price multiplier and the previous period's EMA value. It is computed using the following formula. The current EMA equals to, okay, that formula I showed you guys a while ago. Okay, it's basically the calculations. So what is the difference between the EMA and the simple moving average? Okay, the main difference between the 2 technical indicators is the sensitivity that they place on price changes. So the exponential moving average tends to show more sensitivity to recent price point changes. This makes the EMA more responsive to the latest price changes. The formula for calculating the EMA tends to be complicated, but most charting tools make it easy for traders to follow an EMA, okay? In contrast to the simple moving average, applies equal weighting to all observations in the data set. It is easy to calculate, being obtained by taking the arithmetic mean of prices during the time period in question. Okay, everyone okay with the definition of simple and exponential moving average? Don't worry. Don't worry, when I just learned it, I'm just like, oh, this is so dry. Don't worry, okay. I was there once before. For those who are new here, for those who already learned this, right? For those who already learned this, you're just like, okay, I already know this stuff, right? Then it's how we apply. Okay, so I'm gonna teach you guys the natural moving average, which is what we use a lot here at Everest Fortune Group, okay? Oh, by the way, if you guys are wondering why I'm from Everest Fortune Group, I probably forgot to mention in the introduction. It's because we have a special collaboration, okay? We have a special collaboration to bring you guys these webinars so that you guys can grow as traders. For those who are already profitable, more information to learn, just a different point of view. For those who are still learning and growing as traders, I'm happy to help you guys be even better, okay? So the natural moving average. When you go on Google, when you look for books on moving average, you always hear people saying, oh, the 100 moving average, the 200 moving average, the 50 moving average, the whatever moving average. My question is, can you guys, for those who use moving average, can you guys let me know what number or what settings for the moving average do you usually use? Is it the 50, the 100, the 200? I see Lola saying that she uses the 10, 60, and 200. Anyone else uses a different number? Okay, so Andrej, I hope I'm pronouncing your name correctly, uses the 50 and 100. We've got Kurt using the 50 and the 200 as well, only because that's what a video said to use. Okay, Kurt, I was using the 50 and 100 as well. It's called the golden cross and the moving average. Okay, right. I was using that as well because, yes, I saw a video that told me to use. Actually, no, it was from that course that I went, the one where I paid a few $1,000s to learn about moving average, right? That guy told me to use 200 and 100. I can't remember what it was. Okay, Philip uses the 15, Kingsley uses the 50, the 100 and 200, and Ola uses 7, 14, 89 and 200. Okay, very very uncommon numbers. Okay, so as the answers are coming in, I see a lot of people saying 50 and 200. Why? Because this is commonly believed to be the best settings to use. Okay, I'm not saying it's not good settings. It's just that here at Everest Fortune Group, we have noticed that, I mean, think about it. Okay, think about it, right? Let's say you are going to a party, right? The theme of the party is Hollywood theme, right? You have this beautiful, I know I use dresses as a lot of my references, okay? You have a very beautiful, mini skirt, for example, and very tall stilettos, very tall heels. That short skirt is something you usually use when you go clubbing, right? When you go to the club, you use that very short skirt or whatever it is. But today the theme is Hollywood. Okay, the theme is Hollywood. So you expect really big, gorgeous ball gowns, fancy wavy hair, whatever it is. Okay, the dress will not, the outfit that you choose, which is a short skirt and maybe spaghetti strap, whatever it is, does not fit the theme of Hollywood theme. Okay, it does not fit the theme. So therefore, it's the same when it comes to trading. We don't believe that there is one number that fits all charts and all time frames. So we actually, when you're using the natural moving average, we actually adjust the setting to fit the chart rather than the chart fitting the setting. Do you know what I mean? Right? I understand 50 and 200 is a very common number when you're using the moving average. I personally was using the 50 and 100, but the 50 and 100 does not work on all charts and it does not work on all time frames and all pairs. So the 50 smoothen 10 LWMA low price. Is this okay? Is that a setting that you use, Henry? Right, so we've got different answers. So which one do we use? We have found that the best settings to use when it comes to moving average is to use the moving average that fits to the charts. Okay, so let me try to grab my pen. I actually tried to use a pen. I can't really find the pen. Okay, draw. I think this is it. Okay. Here. Oops. Just give me a sec. Let me just clear out draw. Okay. Can you guys see that this is what people usually use, right? People usually use the 50. When we look at the charts, the 50 looks like this, okay? The 50 looks like this, right? But you can see that there are times where price doesn't really touch the charts, okay? It doesn't really touch the charts, right? So a lot of times when we're using moving average, a lot of traders, okay, there's two very simple and known ways to use the moving average. One is when price breaks above the moving average, you enter for a buy, right? When it breaks below the moving average, you enter for a sell. Okay, that was one of the most common, the easiest thing, the most common thing you hear about the moving average, right? Okay, the other way is to, when price comes back to that moving average, the moving average itself works as a form of support and resistance, okay? The moving average itself works as a form of support and resistance. So every time price comes here, the trader will look to get in for a buy here, look to get in for a buy. When it comes here, look to get in for a buy. It goes up, it comes back, look to get in for a buy. Okay, so that is the other way to use the moving average. Give me a sec. Okay, that's the two ways. So dynamic and support resistance. Yes, correct. That's correct, said Henry. Okay, Karim is asking what's the best moving average to trade on, the 15 minutes or the 1 hour? Okay, when it comes to moving average or any kinds of technical analysis, again, I need to remind you guys that the best moving average that you should be using is the one that fits perfectly onto the the one that fits well on the chart and is effective on the chart. So I would say the moving average is effective on both the 15 minutes and the 1 hour, depending on the settings. Okay, it depends on the settings, right? It can work on all charts depending on the settings. Okay, so let me just erase everything. Let me just erase everything. Sorry, I need to just give me a sec. Okay. Okay, so this is the 50 and this is the 46, right? Can you guys tell me, if you were to get in for the bounce, which charts would you prefer using? Just give me a while, Karim, I'll answer your question in a while. If you were using the strategy, right? If you were using the strategy where you wait for price to come back and you get in for a buy here. Every time price comes back and you get in for a buy here, which charts would you trust more, A or B? Would you trust chart A or chart B more? Okay, yeah, definitely the 46. But 46 is not a common number used for moving average, right? It's just a random number that we chose. Okay, I see someone saying B. Okay, actually why we choose A is because, remember saying the moving average works as a support and resistance, right? So every time price comes back to that support, you expect to get in here for that buy. But can you see here? This is the exact same charts, okay? It is the exact same charts. It's just that the settings was tweaked. The settings for both moving average was changed a little. This one, whoops, let me go back. This one is the 50 and this one is the 46, okay? We manually went into the settings and changed it to the 46. Okay, we manually went to the settings and changed it to 46, and we can all agree that the A looks better when we're looking for entries. Okay, A looks better when we're looking for entries. Why? This is the exact same chart. If we were to use this chart, if we were to use B to get in for a buy, right? Think about it. If we were to use B to get in for the charts, B didn't even touch the moving average and we would have missed this buy entry here. Whereas here on the A charts, okay, price nicely touched the moving average and you enter here for the buy. Okay, so this chart is more accurate. We can safely conclude that the A chart is more accurate compared to the B chart. So whenever we are using technical analysis, to make our decision making, we need to take note, okay? We need to take note that our only job as traders or analysts is to try our best to find the most accurate information, okay? To try our best to find the most accurate as possible information. And there's no black and white written anyway to say that, oh, you must use it this way, you must use it this way. The best way to use something is whatever way that you find is effective, okay? So we have found that this is the most effective way to use it, okay? Okay, let's, let me just remove all the drawings, sorry. Okay, bonus, combining moving average with other strategies. Sorry, this is not the one we're supposed to identify reversals with the natural moving average, and that is exactly the strategy that that is commonly used, which is to buy, get in for the buy. Whenever price comes to the moving average area, you get in for a buy. Whenever price gets into the moving average area, you get in for a buy. The support resistance. Okay, so looks like we still have about 20 minutes. We can do the bonus, which is combining moving average with other strategies. Okay, so let's move on to the live charts, right? Let's move on to the live charts so that we can apply what we learned today. Okay, give me a sec. Let me exit. Let me share a new screen. Since we're doing a practice, we might as well try to find a setup. Can you guys, if you guys have any requests for any particular pair or instrument, do let me know in the chat box, right? If not, I'm just gonna randomly choose one. Okay, I'm just gonna randomly choose one. Let's do maybe sugar. Okay, that's a really, any forex pairs? Sugar is a very uncommon. Okay, I think sugar is a future. It's usually a future chart, right? Okay, let's see how well. Maybe let's do GBP NZD instead. Okay, let's do GBP NZD instead. Let's try to do a forex pair. Because one thing about the sugar chart, we can do it, but because it depends on the chart you use as well, right? This chart, particularly, I wouldn't want to use this because there's a lot of gapping. It's probably because it is not a 24-hour chart. This chart is closed. Okay, let's try to do GBP NZD. I see a request on BTC USD. Would love to do that. I am a crypto trader myself. Okay. Okay. One thing about the moving average that you guys might want to know is that the moving average works very well on trending markets. Okay, it works very well on trending markets. You can see here that market is kind of going sideways. There's a little bit of a triangle going on, right? There's a little bit of triangle going on, but it works better when it is ranging. Okay, it works better when it's ranging. Okay, so there's two strategies that I will be showing you guys. The first one is to use correlation. Okay, look at the charts that we chose. We chose GBP NZD. Okay, we chose GBP NZD as the chart. So can you guys let me know in the chat box, do you know what pair is closely related to GBP NZD? What forex pair is closely related to GBP NZD? There is correlations with pair. It's the same with USD, the Canadian dollar, and oil. Why? Because Canada is a very big oil producing country, right? So the GBP is very closely related to, yes, thank you so much, Kurt. Yes, the GBP NZD is very closely to, number one, the GBP AUD, because the AUD and the NZD is very correlated. Okay, for those who are not sure, you can just go currency correlation strength. Okay. Just go to my FX book. My FX book is a good one. Okay. This is where you find correlation. Okay. Let's say you're looking for the GBP, EUR, actually the GBP NZD. Okay, the GBP NZD, when we compare it to the EUR NZD, you can see that there is 89.6% correlation. It's very, very correlated, okay? Because the GBP is very related to the EUR and the AUD is very related to the NZD, okay? So one way we can use the moving average strategy is to use correlation, but then again, you can use correlation with a lot of things. How you do that, you see this plus button, right? You can plus, click on that, add the correlating pair, which is the GBP AUD. Okay, we're gonna add that in. This is not the one that I wanted. GBP AUD. Sorry, just give me a second. I'm trying to add in another chart. Okay, so you put it as new panel, new. Okay, and it will show below it, right? It will show below it. Just go into settings and change that into. Just change that to. I want to change this to a candlesticks pattern chart. Okay, these settings are tricky. It doesn't matter. You can see the price action going on here. Okay, now we're going to pull out the moving average. We're going to pull out a moving average. Why? Because this is our topic for today. So we'll be focusing on the moving average. Okay, on this, we'll be pulling out the moving average as well. Why isn't this coming off? Okay, guys, I think it's much better if I just open another screen. It'll be much faster if I just open another screen. Usually I can compare both charts. It's just somewhere in the settings that I don't see today. Okay, so one of it is GBP NZD and the other one is GBP AUD, right? Okay, we're gonna go into charts. I'll get rid of this since it's not helping. And we're gonna see how correlated this pair is to each other. Okay, we're gonna see how correlated this pair is to each other. The more correlated it is, the more we want to use it. Okay. I'm gonna get rid of this. Okay, again, this chart was not the best to chart on anyways. Okay, we want to see what is happening on both charts. We want to see what's happening on both charts. So this is the GBP AUD and this is the GBP NZD. You can see that from here, price broke kind of like the moving average to the downside. So naturally, you want to enter for a sell, right? Just using the moving average, you want to enter for a sell. But you can see from the past, every time it broke the downside, it was a fake out. It comes back and fakes out. It comes back and fakes out. So what can we safely conclude? It breaks here, it goes up, didn't really give you a good move, and it came back down, broke it. Okay, you would have been able to caught very small moves. What does this tell me when I'm looking at it? It tells me that the moving average doesn't work very well on GBP AUD on the 1 hour time frame. Okay, let's look at how it works on the GBP NZD. By right, price is supposed to break, go back. Every time it comes here, it's supposed to bounce off. It doesn't bounce off. It keeps breaking and keeps doing fake outs. It keeps doing fake outs, keep doing fake out. It means this is not an effective, moving average is not an effective indicator on the 1 hour on the GBP NZD and the GBP AUD at this current point of time. Okay, maybe in the future it'll work well, but at this current point of time, today, okay, today it does not work well. Okay, so let's quickly go and look at another pair, USD AUD maybe. Okay, and the USD NZD. Okay, I just want to quickly show you guys an example of correlation. Okay, the first thing I'm going to do is change this to the moving average, natural moving average. So how do you look for the natural moving average? What is the settings? I think Someone was asking me earlier on, Karim was asking me, what is the setting? So we don't have a specific setting because again, we are adapting to the charts, right? We don't have a fixed setting, right? It's not 50, it's not 100, it's not 75, it's not 200. It is not a fixed setting. So the settings that we go for is usually using Fibonacci levels number. So the Fibonacci level, that is the 28, okay, the 28.6, the 32, the 50%, the 61.8%, and the 78.6%. Okay, so these are some of the Fibonacci numbers. We try to use this number and we see how well it works. Okay, so let's say we move it to the 28%. Let's see how well it moves. Okay, do you guys think this is a good number to stick on? Okay, price came here, it broke out, did a fake out, came here. By right, when it comes here, it's supposed to bounce. Comes here, it's supposed to bounce. Okay, no, I don't think this is very good settings. So we need to adjust the settings again. We need to adjust the settings until we find a good settings that works well on our charts. So let's try the 32. 32 is not a good one. 50. Okay, I think 50 will not work. Let's try 61. Nope, doesn't work very nicely. You want to find a setting where price was respecting for a while, and that is the settings you're going to be using. Okay, let's try maybe 70. Okay, I think 70 is not the best. Okay, again, I'm just randomly choosing number because I'm trying to find a number that fits well. The thing about natural moving average, because there's no fixed number that you should be using, you kind of just need to experiment and tweak the settings to yourself. Okay, why do I think 70 is a good settings for AUD at USD AUD at this current point of time? Because why? Okay, you can see price broke here, it came here, it reversed. It came here, it reversed. It came back to the resistance, it reversed. Okay, so just using these settings alone, we can safely say that price respected these settings. Okay, only on the third time it finally broke. Okay, it broke, it broke, it broke. It came here. Maybe the settings can be tweaked a little to make the moving average go under. Okay, but that will take a bit of time. We don't have a lot of time left. So let's say I've tweaked the settings to a better number and price was nicely respecting this moving average. Okay, maybe the correct settings would be like 72 or 75, whatever it is. Okay, it comes and reverse here. It breaks this, comes, respected this, turn back, broke, came here, respected this area, bounce, broke, respected this area, bounce, and then it stopped respecting. Okay, so my whole point of showing you this is that you need, when it comes to natural moving average, you need to find the setting that fits well to your charts. Yes, it will take a bit of time to find the correct settings, but you can just randomly jump and hopefully land on one that works. You can start with 10, 20, 30, 40, 50, 60, 70, 80, and see which one works well. So let me try 80 to see. See, the more I adjust, the more nicely it moves naturally. Okay, the more nicely you can see that price came here, reversed nicely. This part doesn't respect so nicely anymore, reversed, reversed, and here it breaks. Okay, so if this continues, if this moving average, this natural moving average is still working good, we expect price to do this, come back and retest nicely here, and then we can get in for a sell. Okay. So the other way, how we use correlation, right? The other way, maybe I can try 88 because that is a Fibonacci level. At 88 doesn't work well. Okay, maybe it's a 70. 70 was probably the, or 80 was probably the best as of now. Okay, now we go to NZD USD. You pull out the exact same settings, which is the 80, and see if that works well. Okay. Let's get rid of everything else. Trying to show you, okay, here price respected the 80. This part didn't respect, this part it respected, this part respected, it respected, didn't respect here, didn't respect here. Now it's not respecting. It just means 80 is not the correct settings for NZD, USD, NZD. Okay, that means we need to tweak it again until we find a better one. Okay, 100 is not the settings as well, maybe 120. Okay, 120 looks like a little bit better settings, right? It looks like a little bit better settings. We need to find the best settings for the charts. Why? Because we are using this to get our entry, right? You know what I mean? We are using this to get our entry. And how I'm using correlation. Okay. We only have 5 more minutes left, so I don't really have time to slowly look for the perfect moving average settings. Okay, it does take some time. Okay, let's say the moving average, I'm just gonna draw a fake moving average. Okay, let's say you found the perfect settings, okay, and it's respecting price. Okay, so why I use correlation whenever, okay, let's say I found the settings and this is the moving average that I think fits best. Why? Because price came here, bounce, came here, reverse, came here, bounce, came here, bounce, came here, bounce, came here, bounce. So when price comes to my moving average again, I expect it to bounce again. Okay, so why am I using correlation? Because if I expect price to bounce, it means that I expect price to be a buy, right? My bias right now is a buy. Okay, the bias right now is a buy. Okay, so now what I do is I go back to my correlated pair, which is the AUSD, AUD. Oh, by the way, the thing that we usually use is actually the AUD, USD, and NZD, USD, but I already typed it, so it doesn't matter. Okay, let's say we have found a very nice moving average to use as well. Okay, and it looks something like this. It looks something like this, for example. Okay. Something like that. So when we're looking at the USD AUD, we are also biased that price is going to come here and bounce. Similarly to USD and NZD. So you're using the correlation on both the charts because, again, when you go to the correlation, you can see that they are, for example, 80+% correlated. They're 87.1% correlated. So the USD AUD and the USD NZD is a very correlated pair. So if your bias for one pair is a buy, the other pair should also be a buy. Okay, do you get what I mean? So that's how you combine correlation with moving average or any other indicator to confirm your bias. Okay, because you know, when I am trading, I think I have won half the battle once I have established the first question. So the first question I always have to ask myself, and I hope I get it right, is price moving in a downtrend or uptrend? Am I getting in for a buy or a sell? Okay. If you got the direction correct, I really think you would have won half the battle already. Imagine you think it's a sell, but actually it's a buy. It's a very, very long buy. So using correlation and moving averages, you are able to confirm, the direction that you want to get in on. Are you getting in on a buy or are you getting in on a sell? Okay, that's one. The second strategy that I'm going to show you guys. So the first one is correlation. The second strategy I am going to show you guys is the usual strategy that I use on a daily basis. One is to combine, right? Combine the moving average with support resistance, Fibonacci levels, the moving average, other indicators, and chart patterns. Okay, so the first thing I'm going to do is look for trend direction. I do see price moving on an uptrend. If anyone else sees anything else, do let me know. I only see price moving on an uptrend. In fact, it is moving in an ascending channel. Okay, it is moving in an ascending channel. Okay, now I am going to highlight some support and resistance Okay, there is support and resistance here, right? There's support and resistance here. Okay, so right now looking at the channel, I am biased that price is going up. Okay, I'm biased that price is going to go up. Why? Because there is bullish momentum. 2, I think price is going to go up here. Why? Because there is a horizontal pullback level here. Okay, 3, why do I think price is going to go up from there? Because when I pulled out the Fibonacci, right, there was the 61.8 lining up on my support, okay, which is giving strength to my support. Okay, that's 3, why I think price is going to go up from here. 4, why I think price is going to go up is because when I pulled out the moving average indicator and I used the natural moving average and I adjusted the settings, okay, guys, again, we don't have time to find the exact settings for these charts. That is just, you have to toggle with it, right? When I pulled the moving average indicator, there was a moving average here. So I expect price to move down here and bounce here. So the other strategy that I'm trying to show you guys is to combine the moving average with other technical indicators to get an even more accurate analysis. It's the same concept as the pink dress that you wanted to buy. You want to buy a pink dress, you don't know if it's good or not. So you ask your mom. Okay, your mom says yes, your dad says yes, it looks good on you. You ask your grandmother, everyone says it looks good on you. There's only one guy who says it doesn't look, it's your brother. Your brother says it doesn't look good on you. But you're thinking, so many people told me it looks good. I don't care what my brother thinks. I'm gonna get the dress anyways, okay? So right now we've got so many things telling us that this is a buy, right? You are going to get into this buy because there's enough reason to believe that price is going to bounce from here. Okay, so you use moving average with everything else, combining with everything else to get an even more accurate analysis. Okay, one thing you need to remember, you need to drill it very hard into your brain, deep into your brain, is that your only job as a trader is to find the probability of whether a trade will work or not. Okay, you want to get in here for a sell. You are now going to use technical analysis, fundamental analysis, whatever it is analysis you have, maybe your gut feeling, maybe whatever it is, whatever you can use to find how probable is price going to come here and reverse from here. Okay, using technical analysis, you will be able to narrow down or give yourself a rough percentage of whether a price is going to work. Because let's say you have established that an analysis is, oh, there's an 80% chance that this is going to be a buy. That means you get in, right? But you see, it's totally different. I think a lot of laymen have a conception that trading is gambling. It is not gambling. It is calculated, collected data and risk management. Okay, the difference with gambling and trading is based on very high probability. Okay, whereas gambling, for instance, you go into the casino, you play blackjack, it's a 50-50. It is a 50-50. Okay, you play roulette, it is a 48% chance of winning. Playing blackjack is a 50% chance of winning. Playing the slot machines is a, I don't know how many percent, maybe 3% chance of winning. Playing, I don't know what other games there is in the casino. I can't even think anything, okay? The probability is against you. Why? Because the probability is so low, chances of you losing to the casino is higher. The casino always has the upper hand to win you. But when it comes to trading and the charts, you get to use technical analysis and all these tools to narrow down how probable a trade is. If it's probable, get in for a trade. If it's not probable, don't get in for a trade. Save the money and don't get in for a trade, okay? So that's all. Yes, I would agree. I really love poker. I think poker is a game of skills, right? I would agree trading is kind of like poker, right? I would have to say poker also has a lot of luck involved in it, right? But trading is maybe a lot more skills and research. Okay, so that's all I have for you guys today. I will catch you guys again. Thank you so much. I'm glad you enjoyed this class. I'll catch you guys again next week. Thanks for attending. Take care, everyone. Hope you learned something. yes, more importantly, hope you learn something. That's the most important thing here. Hope you guys eventually will be able to grow your accounts into millions and millions. Okay, so I'll catch you guys again. Bye guys, thank you so much.
Hello everyone, my name is Emily. We have previously discussed central banks and their role, but this time we will focus on the UK Central Bank. The Bank of England was founded as a private bank in 1694 to act as a banker to the government. In 1946, the government nationalised the Bank of England because of its importance to the UK economy, while in 1997 the government offered it independence in some areas to avoid interference and influence from party politics. The Bank of England is made up of 3 committees which make important policy decisions. We have the Monetary Policy Committee, the Financial Policy Committee, and the Prudential Regulation Committee. These are all chaired by the governor. They also include people from outside the Bank of England who have valuable knowledge or experience. They are called external committee members. The Monetary Policy Committee is made up of 9 members: the governor, the 3 deputy governors for monetary policy, financial stability, and markets and banking, a chief economist, and 4 external members appointed by the chancellor. The Monetary Policy Committee decides what monetary policy action to take and announces its policy decisions 8 times a year. The central bank uses 2 main monetary policy tools. It sets the interest rate that it charges banks to borrow money from them. This is the bank rate. It can also buy bonds to lower interest rates on savings and loans through the use of quantitative easing. Bank rate, also called the Bank of England base rate or just the interest rate, is the most important interest rate in the UK. The Monetary Policy Committee sets bank rate. One of the actions the monetary policy needs to take is to meet the target that the government sets for inflation, which is 2%. The current bank rate is 1.75%. Higher interest rates usually mean a stronger currency. The pound tends to strengthen whenever the Bank of England raises interest rates. However, the Bank of England's current task, like that of other major central banks around the world, is quite challenging as it needs to manage surging inflation and keep the economy from falling into recession. That's all for today, guys. Thank you so much for joining us. Stay tuned for next week. Bye-bye.